Ladies and gentlemen, welcome to It's Rainmaking Time. This is Kim Greenhouse. I have an interesting piece of information for you today. It's been many, many years where I had this feeling that there was this upper echelon of market makers, of masters, of people that were potentially manipulating markets, industries, interfering, exploiting financial markets, sabotaging them, that would bypass good faith human efforts. And I heard about a book called The Quants, How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It by Scott Patterson, a staff reporter at the Wall Street Journal. And I had to call Scott over to It's Rainmaking Time to explain the essence of this book and what we need to know about high-frequency trading and who these quants are. Ladies and gentlemen, please welcome Scott Patterson to It's Rainmaking Time. Good morning.
Hi, thanks for having me.
I want to know what led you to write this book and to research this subject.
In the summer of 2007, there was this extremely unusual event. A lot of these quant hedge funds that operate beneath the surface of the market. Most people never know what they're doing or have never even heard of these funds. Suddenly had a huge blow up. It came out of nowhere, and some of my sources on Wall Street started telling me about a few of these people, and one in particular caught my attention. It was this very secretive proprietary trading operation at the investment bank Morgan Stanley. These guys are so secretive at Morgan Stanley that I started calling around to some of my contacts at Morgan, and they'd never even heard of these guys. So it turned out that they were the largest prop desk at Morgan Stanley. They were running something around $5 to $6 billion for the bank using quantitative mathematical formulas and computers, and they had just gone through a really volatile period. They'd lost about $600 million in the course of a few days. They were run by a guy named Peter Muller, who was just sort of fascinating on the face of it from who he is. He's sort of he's a guy who had moved from New York to California actually, and kind of turned into something of a hippie and a surfer. But he was also really good at math and somehow found himself in this quant world, and came back to New York, was working at Morgan Stanley. At one point, he got really into music. He started playing his electric piano in the subways of New York City, busking for change, even though he was worth hundreds of millions of dollars. So you had this combination of this very secret group and this sort of charismatic person running it that, to me, just screamed out for a story. And I wrote a story. It was a page one story in the Journal. And from there, I started, sort of picking away the layers of this quant world and learned about a lot of other people and, learned what they were doing. And I started realizing that these guys have taken over Wall Street in so many ways, and that's sort of how the book got started.
The quantitative models we know from climate change, for example, are a lot of the times wrong. Basically, whatever you put in, that's what you get out. So it very much depends on what you're factoring in, garbage in,
right.
Garbage out.
Right, gigos.
Yeah, so these simulations, they're supposed to be used as tools to look for what-if scenarios, but it's been turned into the truth in Wall Street, correct?
Mm-hmm.
Explain that.
Right. Yeah, it's a debate that goes on amongst the quants all the time. Is it, was it the models or was it the bad data that went into the models? And it's obviously a combination of both. But I think built into a lot of these models are assumptions about the way that the market behaves, and in the book I call that the truth. It's this belief that there is, by using historical patterns and feeding those patterns into models that are they have certain inputs like volatility, for instance. how volatile the market actually is. That's something that is often just a number that these models are assuming. And when you look at the history of these models, that the volatility numbers are dramatically underestimate how bizarre, how wild, how chaotic the market can be. And I think a lot of times that's actually self-serving, because if the models actually had inputs saying the market could be extremely volatile, you just can't bet as much money. And that's what it comes down to, is the ability. The models are tweaked in order to maximize potential profits, but that is laying the groundwork for a huge blow-up.
Wouldn't you say the quantitative models are revealing the fact that the human factor, as the essence, as the core of it, has been taken out of the equation?
Mm-hmm.
And that represents the X factor, therefore.
Right.
Correct?
Yes, that's one of the big problems is, they're using quantitative formulas that are assuming that human beings are going to act rationally. It's a huge theory that it dominates the way that these guys work. It comes out of the universities. It's called rational expectations. It's also a key component of the efficient market hypothesis. The idea that the market is going to behave itself and act in a way that is predictable. And if you don't believe that, you can't use math and models to make giant bets on the market. And the reality is, and I know that, to me, I was really shocked when I learned that this is what these people think. But because when a normal person thinks about the stock market, you think greed and fear and panics and bubbles and all sorts of stuff that aren't rational at all. And that's I think what happened, especially in August of 2007, when a lot of these quant hedge funds started melting down. Their models were actually operating in reverse. The exact opposite of what they were predicting was happening. So it was definitely an eye-opening experience for a lot of these people.
I think it's fascinating that the human factor in all of this has been taken out of the central equation of quantitative models. For example, when Steve Jobs got ill a couple of years ago, Apple stock dropped like 100 points. Mm-hmm. When that word got out, that's how reflexive, quote, the market and humans are. They thought that the main leader was going to be gone and the company would not be worth as much, so people fled the stock. And I think if you look at that as a microcosm, after reading your book, when you see the high-frequency trades that are going on, and you say they're between 3 and 4 milliseconds a transaction, is that true?
It's actually faster than that. I've learned more about high-frequency trading since I wrote the book, and have written fairly extensively about it for the Wall Street Journal. And these guys are actually measuring trades now in by something called a picosecond, which is a 1/trillionth of a second.
So it's no longer a millionth of a second; it's a trillionth of a second.
Right.
How can that not alter markets, Scott? How can that not alter and impact industries?
It does. It's a big debate going on right now. Why do these funds need to be doing this? Why do they need to be sending so many orders to the markets? And the exchanges like NASDAQ and others like this because they get to charge a small fee for every order that they take. So they're actually encouraging this behavior, and some people think that there's a lot of risk being built up. The high frequency firms doing this claim that there is no risk, and that they're on top of everything, and they would be the first ones to lose out if anything went wrong. So they're very careful. But I think we've all heard that argument before. So it was really mind blowing. And these high frequency firms have really taken over how these markets work. There's estimates that say that the high frequency funds account for 60 to 70% of the volume on the U.S. stock market.
That's frightening. Absolutely frightening. The dark pool. Speak about what a dark pool is. This was an important part of your book. By the way, what shocked me was arbitrage. I thought arbitrage was illegal.
No, arbitrage is perfectly legal, and it makes sense. I think maybe there could be some nefarious ways of doing arbitrage, but basically arbitrage is just figuring out that one the same security is priced differently in different parts of the market,
right?
And you buy one and you short the other until they come together, and it is a perfectly legitimate way of investing, and it actually can make the market more rational and more efficient. It can be dangerous because if you always believe that those securities are going to come together, and this is something that the giant hedge fund long-term capital management did in the late 90s, their entire investment strategy was based on arbitrage and finding out where discrepancies in different securities were around the world and betting that they would converge. And they ended up using massive leverage to make those bets, and then something unexpected happened, and the arbitrage that they were expecting did not occur. It actually went in reverse, just like the quant funds in August 2007. This is what happens when people panic. The rational stuff doesn't happen. So arbitrage is a tried and true method of making money, but it also can be very dangerous when you're using a lot of leverage. But you asked about the dark pools. These are electronic crossing networks. They're off-exchange networks where shares change hands in the dark. Basically, they're pools of stocks, and they started up some time ago in order to for big firms like pension funds to trade large blocks of stocks. And that it made sense because if a pension fund wanted to buy, say $100 million worth of Microsoft, and that got around on the floor of the New York Stock Exchange, that could cause the price to move. So they were trying to create a method where big blocks could change hands without causing the price to move too much.
How do you become a player in a dark pool?
Almost anybody can be a player in a dark pool. Any investment fund, they all use it. These things have proliferated so much that, if you have a mutual fund, there's no question that your portfolio manager is investing in dark pools. They need to, because these things have become a major part of the market. 10% of all stock volume now happens in dark pools. What the SEC is concerned about, and other critics are concerned about, is that there are, because these things are largely unregulated and the trades happen in the dark, that there are firms that are gaming the trades in the dark pools. And it's right now almost impossible to know if that's actually happening. And I've talked to a number of people who think it is happening and have seen it happen. Basically, what a high frequency fund can see something happening on someplace like the New York Stock Exchange where a stock is moving, and it takes a fraction of a second for that price to get to the dark pool. The high frequency fund can calculate that movement faster than the time it takes for that information to get to the dark pool, so they can front run that order. And this is something that I think the SEC is becoming aware of, but it's pretty scary. And this is just just scratching the surface. Who really knows what's going on in these markets where things are happening so fast and in the dark? So it is a big concern.
How does it alter industries, or how could it alter industries, this kind of activity?
I think that gaming is something that it affects the ability of companies to raise money essentially in the most efficient way. If their stocks are being manipulated detrimentally, that could make it more difficult for a company to issue shares and get as much capital as they would like. But you could also have the reverse. You could have a fund causing stocks to go up more than they should, and then the company could raise more. So it's difficult to really know how what the impact is on industries. But I think that you could see a real impact is on the portfolios of people trying to save for their retirements. That's a real concern. Are these super fast traders, sophisticated mathematical traders, picking people's pockets by it will be just pennies per trade, but it can really add up. And this is something I think that a lot of people are trying to figure out is what is the fallout of all of this trading. And there is when there is a positive side to some of this. I don't want to ignore that, because the trading cost, the actual cost of transacting a trade on the market has come down fairly dramatically in the past 10 years or so. And one of the reasons for that is because of these high-frequency traders. You're essentially bypassing the middlemen who used to be the brokers for trades, and those guys charged a fairly high fee. The high-frequency firms, because they're able to do this quicker, are not charging as high of a fee. So there is a benefit, and even firms like Vanguard Group, the big mutual fund company, have said that they think that this is a good thing. But I think that there are costs embedded in the system that a lot of people aren't seeing, and I think that'll come out soon.
Who's making the decisions when a high-frequency trader is trading? Is it the software that's being programmed to execute the decisions? Is it automated? Or is it the trader?
It's completely automated.
Are you serious?
Yeah, these things happen way faster than a human being could contemplate. These are algorithms, and it's something that I've found is that the entire stock market now, maybe 70% or 80% of it, trading is conducted by algorithms. So even your mutual fund manager is probably going to be using algorithms to trade, because of the way that the market is structured now. You can't just send an order to the New York Stock Exchange and expect it to get filled. It needs to be broken up into little pieces and sent around to all these different parts of the market. A lot of this is because of the presence of the high frequency firms. If you were to come out and try to buy, say, 10,000 shares of Google, it's going to cause the stock to move, because the high-frequency firms have algorithms that are sort of like sniffer algorithms looking for trades like that. They're going to cause the price to move up really quickly. So it's a game within the game now. The traders are trying to hide from the high-frequency firms, and the high-frequency firms are trying to see what the traders are doing, and it's a complete transformation of the market, to be honest. And I don't think a lot of people understand this.
It's morphed into something else, hasn't it?
Yeah, it's the computers are going head to head. It's kind of like Cyberdyne Systems in the Terminator. People are using computers, and that's it. That's the direction the market's going. And what a lot of firms are doing now is there's this thing called Colocation, and essentially what that is getting a server, a very powerful computer server, and setting it up right next to an exchange. And so it's co-located with the exchange, so that the orders are sent immediately to the exchange as fast as possible. Last summer, I went out to this new facility that the New York Stock Exchange is building in New Jersey, the size of 3 football fields, It's going to be filled with computers that are co-located with the New York Stock Exchange, and will be processing massive amounts of orders. It'll be, it's a huge endeavor, and there are actually a lot of these other data centers mostly located in New Jersey, where other exchanges they set up big computers and they co-locate all these hedge funds and high-frequency firms and mutual funds and everybody. Banks are co-located, Goldman Sachs, Morgan Stanley, and this is what the market is now. It's a big computer. It's not people calling up each other on the phone and saying I want to buy 1 million shares of IBM. It's pressing a button and having it sent to these data centers, and it's all happened really quickly. And the SEC and other regulators are trying to keep up with it. But this is the future. There's no stopping it.
Wow. Then there's probably no way to really regulate it, is there? Every one of these quant activities is going on in major infrastructure in the financial industry.
Definitely. Yes, and we haven't even touched on derivatives.
I know.
That's another area that I explore in the book is
a lot. Yeah.
The derivatives and those derivatives had a big really at the center of the meltdown, and these are quant creations. These are mathematical constructs that are very complicated and involve shifting money around between parties in very complex ways, and credit default swaps. Obviously, everybody. I remember a couple of years ago, I would ask my friends or family and say, "Have you guys heard of a credit default swap?" And they'd say, "No, what are you talking about?" Because I knew, I could see in covering the markets that these things were becoming very popular and dangerous. And people that I knew, I would say, "What do you think the biggest risk to the system is?" And they would say, "Well, these credit default swaps are going all over the place." And even nobody really knew how big it was getting. But it hasn't slowed down. When I looked just the other day at a chart showing the growth of derivatives on Wall Street, and it's only gotten bigger in the past few years.
Didn't Bernanke give $700 billion, and when he was asked, what was it in, and he said credit default swaps?
Mm-hmm.
Most of us did not understand what that meant.
Yeah.
That he can't figure out what it went to because it went into credit default swaps. So it was like another matrix it went into, and then whatever happened with that was dispersed outward.
Right.
Did you understand that?
Well, basically, a lot of it was credit default swaps. AIG is a perfect example. What AIG was doing was they were entering one side of the credit default swap trade, which was a credit default swap is basically insurance on a bond. It's really not that complicated, although the term sounds devilishly complex. But it's a credit. It's a bet on credit defaulting. So AIG was writing the insurance. They were saying if this debt defaults, we're going to pay up. And a lot of what the debt that they were underwriting were subprime mortgage bonds or collateralized debt obligations, if you want to get it to another level of quant complexity. These were probably the most toxic security Wall Street has ever created, and AIG was underwriting billions and billions of this stuff with no idea of how risky it was. So when those defaults happened and AIG couldn't meet their obligations, they were essentially bankrupt, and the government needed to step in and back those debts, because if they didn't, they owed money to Goldman Sachs or a lot of other firms. Those banks would have to write down their own assets, and it would have rippled through the entire financial system. So So by the government coming in and saying we'll make good on those bets, the other banks didn't need to write stuff down. But there's been a lot of criticism over that action because basically the government was guaranteeing those debts 100% instead of saying, okay, you lost money on some of on these trades, so we're going to only give you 80% of it, to the banks. They gave them all the money, so
it's like a dysfunctional system where you actually cover the gambler's losses.
Right.
Really?
Yeah. I mean, that definitely is what's happened. They call it moral hazard, and it seems to have only gotten worse.
Have you ever been concerned releasing this book, even though it's a New York Times bestseller, for your well-being?
When I was writing it, I got kind of paranoid, because I think that there's a lot of things that people are trying to hide on Wall Street, and maybe I thought people might think that I'm digging into stuff that I shouldn't, and then when it came out, I thought that there would be a backlash, but I think that a lot of these guys that I wrote about are they just prefer to remain quiet about it, because I think that if they came out and said anything, or they might draw more attention to it. So I think they're just hoping it dies and goes away. I want to be clear, I'm not writing about any illegal activities that any of these, but I'm not saying that any of them are doing anything illegal. They were really they were operating within the laws. They were just doing things that were a lot riskier than it seemed to them. And they were, part of what I'm trying to say is this whole system that has built up over decades has encouraged this. It's a belief system. It's an ideology, and it's taken over Wall Street. But there's nothing illegal about it, as far as I know. I mean, I think there were some illegal activities that went on, some very bad behavior, at least, in terms of structuring some of these deals, the subprime deals, and people are still looking into that stuff.
You write about this culture of alpha.
Uh-huh.
Is it a culture of alpha, or is it a cult of alpha? Maybe the Quants are a cult.
Cult-like. It is very cult-like. I mean, they have their own language. It takes a lot of time to figure out what these guys are saying. I think that's part of the hardest challenge for me, was figuring out when you talk to these people, they've got all this jargon that they use. And, eventually I was able to decipher it, because I'm not a quant. I'm a reporter who just learned about this world and had access to it. But I read a lot of books and eventually was able to, make some sense of it. And they have this thing called alpha. They worship it. It's to me, it seems like something out of the Kabbalah, or, it's this belief that certain people are endowed with the ability to beat the market consistently. It's also a mathematical measurement of how much you can beat the market by. But it seems very mystical when the more you learn about it. It's almost like, being a superhero or something.
Interesting. How come you think it is that they were willing to talk with you? There must be something in you that engendered trust, dialogue, etc., to come up with the synthesis of the Quants as a book. What is it?
I knew some of these people beforehand. I had written about some of their strategies before things really went awry for them. I also had started the book in late 2007, early 2008, before a lot of them really had their major problems. So they didn't know how bad things were going to get. I had a sense that all of this was not over, that bad things were coming, and I had no idea how bad it would get. So I was able to learn a lot about them as the big blow-up of late 2008 was coming. And then when that happened, they really stopped talking to me. me because at that point they did not want to be part of a book. And then what happened was a lot of them had lost so much money that they started laying people off, and I was able to get in touch with some of the people who had been laid off and learned a lot more about the inner workings of these groups and some of the stuff that had happened.
Did you get a call from any of the people mentioned in the book after the book came out?
A few, or some angry emails.
Like, how dare you?
Yeah, I mean, they feel like I may have betrayed them. But my feeling is, first of all, these are big boys. They know what they're doing. They chose to talk to me. I'm a reporter with the Wall Street Journal, and I'm going to only report what I see. And if bad things happen, and I learn about bad things and big losses, and I'm gonna put it in the paper. I wrote about Cliff Asness, head of a giant hedge fund in Greenwich, who's a very smart guy, very charismatic and engaging, but he has this explosive temper, and he would smash computers and he would berate employees and very temperamental guy, and blew up at a poker game that these guys have, and I put it all in the book, and he was really angry that I was doing that and thought it had nothing to do with the book. But as I tried to explain to him, it works within the book because you guys are all betting on the market becoming, behaving in a rational way, and yet you guys are crazy. You yourself show how human beings can be very volatile and unpredictable, and that's human nature. And it points to a flaw in the models.
Wow, that's very courageous of you. Has the Wall Street Journal gotten any calls like, you better cut that out, you better quit promoting that book, you should fire that guy?
I hope not.
Has there been any pressure?
I haven't heard anything like that. It may have happened, but my editors would never give in anything like that. They trust me and know that I do my job, and people complain all the time about our reporting, but our editors are always behind us.
That's awesome. Ladies and gentlemen, we have been talking with Scott Patterson, the author of the New York Times bestseller, The Quants, How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It. Scott Patterson, I look forward to having you back. Thank you for publishing this book and researching it and letting us know about high-frequency trading, the players involved, the culture associated with it, and the inner workings of it. And we thank you for being here.
Thanks a lot for having me.